Hi, I am OG John AG, and what just happened in the last 48 hours is not something you can afford to scroll past. This is not a prediction. This is not a theory. This is not someone on the internet drawing lines on a chart and hoping for the best. What just dropped from the biggest bank on planet Earth on the same day silver exploded through $91 for the first time in weeks is the kind of institutional confirmation that changes how every serious investor needs to think about the next 12 months. JP Morgan, the bank that controls the delivery mechanism of the COMEX silver market, the bank that issued 99% of silver delivery notices in January, the bank that has been at the center of every major precious metals manipulation settlement in the last 2 decades. That bank just looked the world in the eyes on February 25, 2026, and said gold is going to $6,300 by the end of this year. And then they said something that should make every single person watching this stop breathing for a second. They said $8,000 gold is on the table. JP Morgan, $8,000 on the table. And in the same 24-hour window that forecast dropped, silver broke through $91. Not $81, not $85, $91. Smashing through a key technical resistance level that traders have been watching for 3 weeks, gold sitting at $5,200. The Supreme Court tearing apart Trump's tariff framework from underneath him, Iran nuclear talks entering their 3rd round, and COMEX registered silver inventory sitting at 88 million ounces, while 350 million ounces of March contracts just rolled over to May. Do you understand what that last sentence means? Let me show you, because this is the part that almost nobody is connecting right now, and the people who connect these dots in the next 48 hours are the ones who are going to be positioned correctly for what is about to unfold. Let me take you through everything that happened, every number that matters, every price level that decides the next move, and then I'm going to show you why May 2026 just became the most dangerous delivery month the COMEX has ever faced, and why the real squeeze everyone was watching for in March didn't disappear, it just moved. It just got bigger, and it's coming faster than anyone thinks. Let's start with the JP Morgan bomb, because the timing of this announcement is everything. On February 25, 2026, JP Morgan raised its year-end 2026 gold price forecast from $5,055 per ounce to $6,300 per ounce. That is a $1,245 upward revision in a single analyst note. In the same note, JP Morgan analysts made a case for $8,000 gold, citing central bank buying acceleration, the dollar's structural decline, deteriorating U.S. fiscal credibility, and what they called a fundamental repricing of reserve assets. Let me put that in plain language. JP Morgan is telling you that gold is not done moving, that the crash from $5,600 to $4,500 in late January was not the end of the bull market, that the institutions who understand the actual plumbing of the global monetary system believe gold has another 22% from current levels just to hit their base case target, and another 54% above that in their bull case. And this is JP Morgan, not a YouTube channel, not a newsletter, not a retail analyst with a Twitter account. This is the bank with the most access to central bank flows, the most insight into sovereign gold demand, and the most proprietary data on institutional repositioning in the world. They are not saying $6,300 because it sounds exciting. They are saying $6,300 because their models, fed by data the rest of us cannot see, are telling them the bid for gold does not stop at $5,200. And when JP Morgan drops a forecast revision of this magnitude, it triggers a cascade. It gives other institutions permission to raise their own targets. Goldman Sachs already revised up to $5,400. UBS is sitting at $6,200. Bank of America has been quietly upgrading their precious metals desks for 6 weeks. When the biggest bank in the derivatives market tells the world that $8,000 gold is on the table, that is not a minor headline. That is a generational signal. And here is the piece that makes it even more explosive. Silver is still 30% above where it was a year ago. Silver just broke $91 on February 25th, and JP Morgan's own forecast for silver in 2026 averages $81 per ounce, which means even their conservative internal model has already been blown through. When the base case is surpassed and the bank is simultaneously raising gold forecasts to $6,300 with an $8,000 case, what do you think that implies for silver? Silver does not trade in a vacuum. Silver tracks gold, but silver is smaller. Silver is thinner. Silver is where industrial demand is accelerating. At the same time, investment demand is surging. At the same time, supply is structurally constrained. When gold goes to $6,300, the gold-to-silver ratio at current levels implies silver above $105. At the historical average ratio of 60, silver at $6,300 gold implies $105. At the 2011 ratio of 30, which we briefly touched in January, you are looking at $210 silver. These are not fantasy numbers. These are the outputs of a simple mathematical relationship that has existed for centuries. And the input just got revised to $6,300 by JP Morgan with an $8,000 bull case. Now let me walk you through why silver broke $91 on February 25th and why that specific breakout matters more than it appears on the surface. Silver had been grinding in a range between $80 and $90 for most of February, recovering from the catastrophic crash of January 30th when it hit $71 intraday. The market was healing, the weak hands had been flushed. Speculative positioning in silver was near two-year lows based on the commitment of traders' data. The structural buyers, the people who actually understand the physical market, had been accumulating at $72, at $75, at $78, at $82. And then February 25th arrived with three simultaneous catalysts that broke the ceiling. First, the Supreme Court ruling striking down Trump's broad tariff authority under IEEPA created massive uncertainty about the entire U.S. trade policy framework. Trump went to his State of the Union that same night and called the ruling very unfortunate. He vowed to reimpose tariffs under a different statute. He doubled down on wanting tariffs to replace income taxes. This is not de-escalation. This is the trade war entering a new, more uncertain, and more legally chaotic phase. When policy is uncertain, when the rules of the trading system can change week to week based on what a president says at a podium, capital moves to assets that exist outside that system. Gold exists outside that system. Silver exists outside that system. Second, Iran. Trump went to his State of the Union and said the United States is in negotiations with Iran over nuclear weapons. In the same speech, he threatened strikes if talks fail. Round 3 of U.S.-Iran indirect nuclear talks is happening in Geneva as I record this. The market does not know whether this ends in a deal or in bombs, and when the market doesn't know whether it ends in bombs, a geopolitical risk premium gets embedded in every asset that functions as a safe haven: gold, silver, hard assets. Third, the dollar. The dollar index dropped below 97 on February 25th. When the dollar weakens and the world's largest bank simultaneously raises its gold forecast to $6,300, you get silver at $91.18 at the high of the session. You get momentum buyers piling in. You get algorithms triggering on the break above $90. You get the narrative shifting from will silver recover to when does silver hit $100. But here's the piece you need to understand if you are watching this right now. The move above $91 was real. The reversal that came after it was also real. Silver pulled back to around $87 into the close of February 25th due to a massive China-driven liquidation event. This is the same pattern we have seen repeatedly since January. Price spikes, Chinese leveraged positions get forced out, price corrects, physical buyers step in, price recovers. The China liquidation is not a change in the structural story. It is the weekly volatility event that the paper market generates while the physical market underneath it continues tightening, and the physical market is tightening in ways that should terrify anyone who is short silver on paper right now. COMEX registered silver inventory is at 88.19 million ounces as of the most recent report. In October 2025, that number was 167 million ounces. In 5 months, COMEX has lost 47% of its deliverable silver, and the drainage is not slowing down. In the week of February 17th through 21st alone, registered inventory dropped approximately 3 million ounces. At that pace, we are losing roughly 600,000 to 800,000 ounces per day from the only pool of silver that legally counts as deliverable under a COMEX contract. But here's the headline that everyone in this market is talking about right now, and almost nobody in mainstream media is explaining correctly. 350 million ounces of March silver contracts just rolled to May. The March delivery squeeze that we have been tracking for 6 weeks did not result in a default. It resulted in a roll. The majority of open interest did not stand for physical delivery in March. It moved to May. And that sounds like good news on the surface. No default, no force majeure, no emergency. But look at the math of what just happened. 350 million ounces of theoretical silver demand just moved from a month where COMEX had 88 million ounces of registered inventory to a month where COMEX currently has approximately 87 million ounces of registered inventory and counting down every single day. If the drainage rate continues at 700,000 ounces per day from now until the May 1st notice day in late April, We will have somewhere between 65 and 70 million ounces of registered silver available to service delivery demand that now represents 350 million ounces of rolled contracts, plus any new buying that enters between now and April. The ratio of paper claims to physical silver is not improving. It is getting worse. March did not resolve the problem. March moved the problem forward in time while shrinking the physical inventory that will face the next battle. That is not a squeeze averted. That is a squeeze deferred and amplified. And the people who understand COMEX mechanics, the people who watch JP Morgan issue 99% of January delivery notices, the people who saw delivery rates in February running at near 98%, they know what this means. They know that the same dynamics that nearly broke the system in March are now pointed directly at May with even less registered silver available and even more rolled forward paper demand stacked up against it. Let me give you the exact price levels to watch, because right now everything is trading in a zone that will determine the next major directional move. Silver closed February 25th around $87.50 after hitting $91.18 intraday. Here are the levels that matter. Below $85, that is the first major support zone. This is where the 50-day exponential moving average is converging with technical support from the February recovery. A daily close below $85 would be bearish and could open the door to a retest of the $80 to $82 range. If we are at $85 and the volume is light, that is likely a fake out. If the volume is heavy on a break below $85, the algorithms are targeting $80 next. Between $87 and $91, this is the consolidation zone. This is where the bulls and bears are fighting right now. The bulls won intraday on February 25th when they pushed above $90. The bears won the session when China-driven liquidation pushed the close back to $87.50. If silver grinds sideways in this $87 to $91 range for 2 or 3 sessions with declining volume, that is not weakness. That is coiling. That is the spring being compressed before the next leg. Above $91, that is the game changer level. The next significant resistance above $91 is at $94 to $95. Above that, it is $97 to $98. And then the 3-digit barrier at $100, which is not just a psychological level. It is the number that triggers mainstream media headlines, retail FOMO inflows, and institutional upgrades across the board. A clean daily close above $91 with strong volume and gold holding above $5,200 simultaneously is the setup you want to see. That would be the signal that the consolidation is over and the next leg toward triple digits is beginning. For gold, watch $5,200 as the battleground. Below $5,200, we are in a chop zone. Above $5,200 with a close above $5,250, you are looking at a measured move toward $5,400, which is Goldman Sachs's current target. Above $5,400, you have clear air until $5,600, which was the January all-time high. And JP Morgan just told you their base case is $6,300. Now let me connect all of these threads because this is where the picture becomes undeniable. You have JP Morgan saying $6,300 gold with $8,000 on the table. You have silver breaking $91 driven by the same forces that took gold to all-time highs in January. You have COMEX registered inventory at 88 million ounces and draining. You have 350 million ounces of March contracts rolling to May, meaning the squeeze did not disappear, it relocated. You have the Supreme Court creating structural uncertainty around U.S. tariff policy, which means the geopolitical and trade war premium in precious metals is not going anywhere. You have Iran nuclear talks that could either end in a deal or an escalation, and the market is pricing in the possibility of the latter. You have the dollar below 97 and U.S. fiscal deficits running at $2 trillion per year, with debt service above $1 trillion annually for the first time in history. You have the Federal Reserve paralyzed between an economy showing signs of stress and a trade war that threatens to import inflation. Current expectations have the first Fed rate cut priced for June 2026. Every basis point of expected cuts is a tailwind for precious metals. Every weak economic data print between now and June is a tailwind for precious metals. Every tariff escalation from the White House is a tailwind for precious metals. And every day that COMEX registered inventory drops by another 700,000 ounces is a tailwind for the eventual May delivery reckoning. Here is something that almost no one is reporting, but that explains the current price dynamics perfectly. Silver is outperforming gold in 2026. Silver futures are up approximately 30% year-to-date. Gold futures are up approximately 20% year-to-date. Silver is the better performing asset in 2026, not because of speculation, not because of retail FOMO. Because silver is simultaneously a monetary metal and an industrial metal, and the industrial side of the equation is getting more urgent every single day. Tariffs on imported goods mean more domestic manufacturing needs more silver. AI data centers need silver for their circuit architecture. Every solar panel deployed in the energy transition needs silver. Every electric vehicle charging station needs silver. The U.S. Inflation Reduction Act, even in its modified form under the current administration, is still incentivizing solar build-out that consumes silver at a rate the mining industry cannot match. And China's export restrictions on silver, which took effect January 1, 2026, and require state licensing for any company with less than 80 tons of annual refining capacity, have locked 60 to 70% of global refined silver supply inside Chinese borders. The supply that is available to Western markets is structurally tighter today than it was 1 year ago. And it will be tighter still in 3 months when the May delivery period begins and the paper market is forced to confront the physical reality of 87 million ounces of registered inventory against the rolled forward demand of what was 350 million ounces of March contracts plus the new buying that enters between now and late April. Let me address the bearish case because if I don't give you both sides, I'm not doing my job. Silver fell from $91.18 to 80 cents a month 50 in a single session on February 25th. That is a $3.68 drop from the intraday high, a 4% reversal. And the cause was a massive China-driven liquidation event. We have seen this pattern repeatedly, and we need to respect it. The Shanghai Futures Exchange is home to enormous speculative positioning in silver. When those positions unwind, they hit the global market with selling pressure that is disproportionate to any fundamental news. The SHFE announced new margin requirements for precious metals recently, raising general position margins to 22% and hedging margins to 21%, with daily price limits adjusted to plus or minus 20%. When you tighten margin requirements, you force leveraged holders to either post more capital or close their positions. When they close, they sell. And in a market as thin as silver can be at certain hours of the trading day, that selling moves price fast. If China continues these liquidation cycles, if the PBOC or the SHFE decides to cap silver prices as part of a broader commodity management strategy, if a price floor is set that triggers forced short covering or forced long closing depending on its level, we could see more of these sharp intraday reversals. This is not manipulation in the way retail investors understand it. It is the complexity of a market where physical and paper are increasingly disconnected, and where state policy in the world's largest silver market can override pure supply and demand signals in the short term. The other bearish factor is the U.S.-Iran nuclear talks outcome. If Iran and the United States reach a comprehensive deal and sanctions are lifted, the geopolitical risk premium in precious metals compresses. Gold and silver would likely pull back on the headline. How much they pull back depends on how comprehensive the deal is and how quickly markets price it in. But understand that even if a deal is reached, none of the structural factors that pushed gold to $5,600 and silver to $120 in January disappear. Central banks are still buying. Fiscal deficits are still $2 trillion. COMEX is still draining. The silver supply deficit is still in its 6th consecutive year. A geopolitical relief rally in the dollar translates to a temporary headwind for metals, not a structural reversal, and any pullback into $82 to $85 silver in that scenario would be an opportunity, not a disaster. For the long-term stackers in this community, nothing about the current price action changes your thesis. You are accumulating real metal, physical ounces, in a market where the paper price is determined by entities that have demonstrated repeatedly and in documented COMEX data, the ability to move price 20 to 30% in either direction in a single session using paper contracts that outnumber physical supply by 5 to 1. You are not buying the paper price. You are buying the physical metal at whatever the paper market offers you. When JP Morgan says $8,000 gold is on the table, when silver is in its 6th consecutive year of supply deficit, when COMEX registered inventory is at 88 million ounces and falling, when 350 million ounces of demand just rolled from March to May and is compressing into the next delivery month, the long-term physical holder wins, not because of the next 48 hours, because of the next 4 years. For the traders, here is your framework for the next 2 weeks. Silver between 80 cents and $91 is the range. Watch the volume. If you get a close above $91 on volume above 25,000 COMEX contracts in the first hour, that is an institutional buy signal. That is the breakout that targets $94, $97, $100. If you get a close below $85 on heavy volume, That is the short-term bearish case, and you are looking at a retest of $80 to $82 before the next leg up. The gold-silver ratio right now is approximately 57 to 58. Historical average is around 60 to 68. If gold is heading to $6,300 per JP Morgan's base case, and if the ratio merely holds at current levels, silver is north of $108. If the ratio compresses back toward the 50 level that briefly touched in January, you are looking at 126er silver at $6,300 gold. These are not screaming predictions. These are outputs of the mathematical relationship between two assets and the most credible institutional forecast for one of them. Watch the ratio. When gold makes a new all-time high above $5,600, watch whether silver keeps pace or lags. If silver lags, the ratio widens, and it is a setup for explosive catch-up. If silver leads, as it did on February 25th when it broke $91, while gold was still at $5,200, that is the market telling you the structural story for silver is accelerating faster than even the gold narrative. Let me leave you with the single most important data point of everything I have shared today. In the last 5 months, COMEX registered silver inventory went from 167 million ounces to 88 million ounces. That is a 47% decline. The rate of drainage is accelerating. 350 million ounces of March contracts just rolled to May. JP Morgan says gold goes to $6,300 and $8,000 is on the table. Silver just broke $91 this week while gold was at $5,200. The gold-silver ratio implies $108 silver at JP Morgan's base case gold target. The silver supply deficit is in its 6th consecutive year with physical investment demand forecast at 227 million ounces in 2026, a 3-year high. China's export restrictions are locking 60 to 70% of refined silver inside Chinese borders. Trade policy is in chaos after the Supreme Court ruling. Iran talks are ongoing, and the outcome is unknown. The dollar is below 97, and U.S. fiscal deficits are running at $2 trillion per year with no sign of reversing. Every single one of those factors points in the same direction for anyone willing to follow the data to where it actually leads. The question is not whether silver goes higher. The question is what happens to the paper market when May comes and 88 million ounces of registered inventory tries to service what could be hundreds of millions of ounces of physical delivery demand from a contract market that has been draining since October. March didn't break the system. March bought the system time. That time is now being used by the smart money to accumulate physical before the next reckoning. And the dumbest thing you can do right now is watch all of this data. Hear JP Morgan say $8,000 gold is on the table. Watch silver break $91 after being at $71 5 weeks ago. Watch COMEX drain 700,000 ounces every single day and decide to sit on the sidelines because the price is volatile. Volatile is how silver moves. Volatile is the price of entry for the kind of returns this market delivers to those who understand it. If you are getting clarity from this analysis, share this with one person who is watching the market and missing the structural story underneath the daily noise. The May delivery period is the next event. COMEX inventory is the clock. 88 million ounces and counting down. Invest with logic, not hype. Use your own brain. Don't follow anyone blindly. OG out.